What's going on, guys? Brian's here. Today's Friday, February 4th, 2022, and the market is closed. Now, sorry I haven't been able to upload a video to the YouTube channel in a while. I've actually been doing a lot of one-on-one sessions as well as a lot of 2 to 3 hour long webinars for the quant trading app Discord, as that's largely where I've been as of late, as well as continuing to build the quant trading app algorithm. And if you guys don't know, I'm the lead developer for this platform right here. I'll talk about this a little bit later in the video because it's actually going to be important for how I took this trade on Tesla. Now, that aside, or quant trading app aside, there's some key things that I think a lot of traders are missing right now because everyone is so dialed in or so tuned into the micro picture that we tend to forget the greater context of things. And there's a lot of massive opportunities for swing trades in the market right now, especially with options. If you know how to trade spreads, there's a sort of a mystery behind spreads because it's not as popular as just buying naked options, which is when you just buy a call or you buy a put. If you think a stock is going to go up, you buy a call and you hope it goes up. However, most people don't like doing that because, as we know, the market has been very volatile as of lately, and the volatility, I think, is clouding a lot of people's judgments because if you know how to really manage your risk well, especially with a spread, it's actually not that difficult to be able to do. So I want to show you guys an example of this trade that I took on Tesla. I swung it from last week Friday. I did not hold it for this whole week. I actually took profit on Monday. I do wish I held it for the whole week, and I do wish I had a little bit more size, but I'm currently in the process of building out a couple smaller accounts myself as I started the year fresh this year. So as we look at things, let's just start with a little bit of TA, which is technical analysis. Nothing fancy here. This is the 200-day moving average. If you're new to trading, please use the 200-day moving average. It's about the only simple moving average you need on your chart, and this right here is the 50 moving average, but it's not relevant for this video. This is Tesla at the 200-day moving average. We can see how important it's been in its past, over the past couple years, since they've become cash flow positive, which I think was announced in this earnings call right here. Every time Tesla's come down to the 200-day moving average, it's been of importance. This was the first time in which it's touched since this massive run up right here, and this retracement was bound to likely to be some sort of a place for it to get stuck. Now, if you don't use simple moving averages, this right here, it was a key zone for the charts, what we would refer to as a demand zone, because we can see all the buying pressure that was building up in Tesla right here leading into this earnings call before it entered this massive gamma squeeze. So we had this demand zone, reason number one. We have the 200-day moving average, reason number two. Now let's take a look at something like this here, just traditional technical analysis. Again, we have a little bit of support and resistance level here, so let's just call that 3, as well as the fact that this is the whole psychological level of $800. Very important key level for Tesla because it struggled to break over this level since it broke down last year. It flew past it, and this was also a retracement. So we have a few key levels. Now I'm going to show the fourth level right here before I'm just going to type it up on the chart so I don't have to write this out again. Let's just zoom up, and for those of you that love your trend lines or your channels, let's just try to draw something out pretty quickly here and just try to connect some of these levels here. And let's draw out maybe some sort of a channel. Again, the channel is not really what's important for what I'm talking about here. It's just more so this trend line support down here. We can see how important it was. So this is the first time in which Tesla was also coming back to this trend line after breaking. So if you've seen any of my previous swing trading videos, and I'm not much of a technical analysis based trader myself, most of my trades now are based on some sort of quantifiable information. So let's jump into something that I use the quant trading app algorithm for, as well as the data on my Instagram. Let's just show you. I want to show you guys this right here. I was super excited because I posted a little bit of a joke. This was the Thursday before Tesla was selling off. I just made this joke about who was ready to blow their Tesla on same day expiration options. I was pretty excited because first and foremost, there was a lot of an imbalance in options in the premiums for Tesla. There was a lot of deep in the money puts for this expiration right here. So this was for the January 28th, as well as for the following expiration, which is today as I'm recording this video. So the following Friday was February 4th. Understanding that I think there was combined over $40 million in the money puts, and there was hardly a few million in calls. Usually whenever you see that type of imbalance, the market usually likes to balance itself out, and that's largely because all of these deep in the money puts are usually sold. And whenever the market, or whenever any type of underlying, and I'm not necessarily talking about a junk stock or a garbage stock, if you will. We're talking about something that's as powerful as Tesla. This has the top 3 most expensive options chain on the entire market, next to stuff like the SPY and knowing that there's usually a lot of flow of money in Tesla, being able to pay attention to how the premiums are moving is pretty important. On top of that, Tesla was below this Friday what's known as a 2 sigma level, so I'll show you guys that in a second. So using quant trading app provided additional 2 more reasons, but we already had 4 reasons, just traditional technical analysis. And then as we dived a little bit deeper into looking at the option premium, that provided a 5th reason, and then the 6th reason being we were below a 2 sigma level, which is very important for reversals for the following week. So I had 6 solid reasons coming in. But again, even if you didn't have that many reasons and you're just using simple technical analysis, you should be thinking about this like, hey, how can I position myself to be long Tesla? And don't think about it in terms of just this one day, because if you think about it in terms of this one day, you're just training yourself to only catch these smaller moves, or chances are if you're a new trader, you have to put on so much outsized risk because you have to put so much capital on a trade to be able to capitalize on small moves in relation to assuming you got the perfect entry. We'll say like $800 is where you went long. Tesla went all the way up to 950 or 940, we'll say. So we're talking about 140 points. Meanwhile, on this day, you might have only been able to capitalize on 20 points or so. You should be asking yourself, how can you train your mind to be able to catch some larger moves? And we'll say 100 points is a decent amount of a return on Tesla when you're thinking about swing trades, because as you guys can see, its ranges are pretty massive right now. So less of thinking about this, I think, and more about thinking about being able to capitalize on these types of moves, because it means if you're capitalizing on 100 points, it means, let's just say you do this with 1 share. That means with 1 share, you make $100. However, if you only can capitalize on 20 points and you have 1 share, that means you're only making $20. To make the same $100, you have to put 5 times the size on this. So that means you would need 5 shares to make $100, which means you're putting on more capital into the trade. It doesn't mean you have the same risk just yet unless you're swinging, but this is the same amount of capital that you can actually get bigger returns using less capital. And who has less capital? Chances are, if you're a new trader, you don't have access to that much money as of yet. So if you can start off this way, if you're watching this video as a new trader and you're just curious about, I haven't gotten into the spreads department yet, but I just wanted to talk about that and kind of use that as the prelude to how can you train your mind to look for these bigger pitches whenever there's these types of opportunities, because we're talking about a massive amount of confluence right here. So moving right along, let's take a look at the options chain. This was a screenshot for when I submitted my trade. What I entered was actually a long call butterfly, and that's what's down here. I'm going to break that down in a second, but there's something I want to show you guys. By entering this this spread, this was the price in which I was paying for it. I think I actually got filled at $1.14 or $1.15 or something like that. What's neat about being able to enter in a spread like this to swing, it means this is the most amount I can lose, just $113 on the trade. So if we think about this, if I'm only, we'll just round this down and we'll say $100. So I'm putting $100 into the trade because naturally that's 100 times, that's just the way options work. So if you're paying for $1 for a spread, the options multiplier is 100. So that means it would cost you $100 even though the option spread itself only cost $1, or the option itself only cost $1. So again, as we're looking at this, let's assume this is $1 just to keep it simple. If we were to find the equivalent on the options chain, and I actually have a screenshot right here. This was not taken at the exact same time, but this was on that day. Let's just zoom that in. All right. So this right here I highlighted, this is what a $1 call option was going for at that time. And look at the strike price. So 10.25. Tesla at this point was trading at 124. So we're talking about 200 points away. That's very far out the money. You guys can see that this is at the money. This is how far that is on the options chain, which means the chances of making money on this call is very low because it's so far away from the current strike price. And the further away you go, the less chances you have of actually being right. So how can you improve your probability of success? Usually you can go closer to at the money. However, the closer you go at the money, there's more capital you have to put out. So we're talking about the difference between putting out $1,000 on this call versus putting out just $100 on this call. This has a higher chance of working, but it's going to cost a lot more money, 10 times the amount. So how do you counter that? You can enter in a spread to increase your probability of success. Now, before we actually jump into the spread, I want to also mention the Greeks right here. So on this column, this is the delta and on this column, this is the theta. I want you guys to recognize something right here. The theta on this call is negative 37. That means every second that you're holding an option, you're essentially being hurt by theta, especially when you're trading options that expire less than 60 days till expiration, and definitely less than 60 days till expiration. So in this case, this contract expires 7 days from expiration, which is the current day, which is today as I'm recording this video. Minus 37 means every day this contract, granted, if none of the other Greeks change or implied volatility doesn't change or anything, this is just assuming it's in a vacuum, this contract will lose 37 cents every day. So right off the back, it's pretty much losing a third of its value every single day just to hold. However, its delta is only plus 3 cents. So that means for every $1 Tesla goes up, this call gains 3 cents in value, which means you make $3 in total, 3 actual dollars, not $300 using the option multiplier. You're only making $3 for every 1 point Tesla goes up. So in other words, if Tesla was to jump up 10 points, you would make just $30 is how much you'll actually make, right? And that's a big move. Tesla moving 10 points. Well, relatively speaking, we'll say we're looking for 100 points here. So if it moves 10 points, you're a tenth of the way, you would have just made $30. That's not very impressive because the delta is so low. So again, if we were to trade this option up here or around the $10 one, we can see this delta is 23. Now that's pretty impressive because not only the closer a contract gets to being at and in the money, the delta actually starts increasing. So you'll actually start making more by holding this call as it gets closer to becoming in the money. But again, look at how dangerous the theta is on this. This call is going to lose this much value every single day that it's being held. Also risky, right? So if we jump back, I was looking at the chart and I was like, Tesla is more than likely going to be over $900 was the assumption, we will say. Without getting pretty fancy, my logic was that we're going at least over $900. However, I did not want to buy the $900 call. I wanted to use the low of this day as my stop loss in case Tesla had gaps down. I wanted to know how much would I actually be down. And that's why I decided to enter a spread. And I'll pull up this right here is actually what the spread was that I opened. And this is what's called a butterfly spread, but I actually adjusted it. You can do a lot with butterflies. You can make them unbalanced. You can make them broken wings. You can do a lot with them. They're very customizable and they're actually a little bit beginner friendly once you get used to understanding the mechanics behind it. So when you're running a traditional butterfly, you're essentially going to sell 2 of a strike and you're using the credit received from that to pay for 2 other options. And these is what would be referred to as the wings, and this is what would be the body. So let's jump over to option strat. And yes, this is an example of a traditional butterfly. So in this case, it's a long call butterfly because I'm doing it with just calls. And this is saying I'm selling 2 of these calls and receiving a credit. So how much for selling 2 of these calls? These calls are going for $17. We'll just say 18. So by selling 2 of those, we're collecting $36 in premium. So that's a lot of money being collected. However, we're going to take that $36 in premium and spend it on buying a call that we think something is actually going to go to. So in this case, 930, and let's see how much that's going for. So for $26. So we have 36 to spare. We're going to spend 26 of that on this one. So then that's going to leave us still with $10 in premium in credit left over. And then how much for this one? This is going for $11. So as it's all said and done, again, my math is slightly off here because this is obviously not 18. It's this application option strat is actually doing all the mechanics for us, and you can do the same thing on your Thinkorswim chart or any platform. You can even do this on Robinhood. But what we're looking at right here is saying when it's all said and done, this ends up being how much we're actually spending for the trade. It's just $220 because the cost of this spread will be $2.20, which is not bad. And again, this is a spread. This is not one in which we ran. I just wanted to show you guys what a butterfly looks like. We can widen these wings right here, and let's just say we wanted to go 50 points up and 50 points down. This is showing the range of profitability, which means if we think Tesla is going to go up but not too far, it's just going to land around this area. We can hover this and see what our max profit would be if it actually ends up being at this strike price. The reason this ends up being our max profit is because at expiration, because we shorted 2 of these calls and we're collecting that premium, it means the money we collect or the credit received from selling these ends up being money we get to keep if it expires right at that strike price, or if during power hour, because I never suggest holding any type of butterfly past 9:30 p.m. on the day of expiration. So if I was to run something like this, 7 days till expiration, this upcoming Friday, I would be looking to close it out by 3 p.m. Eastern time, the latest. So 1 hour just before the market close. But what you guys can see is we can actually adjust this and maybe pull this in. And by doing something like this, when we have a traditional butterfly, we have a little bit of risk on both sides, meaning if Tesla went too far, we'll actually end up taking a loss on one side. But the way this works is if we were to pull this down, we can see by the day of the week. So let's just say we wanted to know by Monday, how much would our profit and loss be if Tesla was to gap up? We can see in this case, we'd be up $350. Now, if we're running a spread like this and it's costing us $1,300, and we're up $300, almost $400, that right there is already over 25% or so of the position. We can actually just press this right here and see. So 20, 25, 26% of the position is what we would expect to be our return, even though we're not holding until the Friday. We're just talking about holding until Monday if we were expecting Tesla to gap up. But now what we're doing is we're increasing our odds of success as well as limiting our risks, because if we were to say, if Tesla was to actually gap down on Monday, let's just say we held past the first couple hours of the day, Tesla would have to go all the way below $900, and Tesla's currently trading at $923. So let's just say you're using traditional technical analysis and you're saying like at $895 is where you'd like to stop out. You can use a risk profile and see if Tesla was to sell off to that price. You guys see the price right at the top right here. So this right here would be $895. You'd be down $170. That's a pretty wide stop loss considering your technical analysis or whatever support level you might have. But however, if Tesla actually went up by Monday, you're up $400. So now you're only risking $150 or so to make upwards to $400 if the setup applies to you. And then the longer and longer you hold, the closer and closer it gets to expiration, the higher amount of profit you can actually make. So that's inherently, again, that's probably a poor example. If this is your first time you're seeing a butterfly, I apologize. I need to do dedicated videos just on these spreads. I'm kind of baking in a little bit of an introduction to the butterfly while I'm trying to explain a larger concept. But what I want you guys to take note of is at this point here, when I wanted to swing Tesla, let's actually dive into the smaller time frame. And let's just clear this entire chart here. And let's actually create a new drawing set, and let's actually just make it completely blank so we can just look at price action. Press create. We can see this right here. This is essentially where I went long because, again, all the aforementioned reasons. Intraday now we had a nice pullback. If we're using some sort of retracements, we can say we finally came back. There was going to be some sort of confluence here to be long because of volume profiles, VPOCs. If we were to go to this time frame here, we can see that there was if you watched any of my other videos and you were curious to say like, oh, maybe there was a VPOC here. Yes, there was. Here was a VPOC right here. So it was the first time in which price had come back to this level. I believe it was touched at the previous day, but there was a little bit of confluence here. This was not, I was not aware of this at the time. It didn't matter. There was more than enough confluence, but I'm just showing you guys at this point, we've already identified 7 or 8 reasons to have been long in this area. The macro point of this video is to understand when these opportunities are in front of yourself, you should not be thinking about, oh, can I just capture this 10-point move or this 20-point move? How can I capture this 100-point move, but also eliminate my risk? So by entering the spread, in which I entered this right here, would be my actual order window. You can see it ended up costing me about $1. It ended up costing me $115, and this is the chance for max profit. So I just want to show you guys how this trade played out as well as the mechanics behind it. So this is saying I need Tesla over $930 at expiration. However, as we can see, as we're analyzing this right here, if we emulated the trade now, and let's just say I was to run something similar. So we'll go up here and then we'll pull this into about right here because I don't want any upside risk. Now we're talking about a trade that's going for about $2. And I need Tesla over $977 at expiration, but I'm not planning to hold till expiration. I'm just looking to swing, into Monday or so. Now we're talking about the chance for it to go up to 300 and change in terms of profit if we think Tesla's going to go to 1,000. However, if Tesla gaps down, how much would I be down? Just $100. So now we're talking about risking $100 to make potentially $400. So that right there is a 4-to-1 in terms of risk reward, because the difference between when you run this type of spread, if we were to go back to this options chain right here, as we were looking at this call, which has almost no chance of making any serious money because it's so far out the money, unless you just get lucky, this is considered a low probability trade. You have theta against you, so you have time eating away your contract a whole lot more than your delta. So even if you're right, as Tesla's going up, you're not going to make that much money. And then you want to keep your cost down, so that's why you're buying a cheap option. Look at these Greeks, 0.3 and -37. This is the comparison to, this would be the Greeks at the time in which I opened the spread right here. So the delta was 2.26. So in other words, for every 1 point Tesla went up, I would make $2.26 is how much this spread would increase. But more importantly, look at the delta. The delta is only -14. That is a huge difference between. So if we put them side by side now and we can compare, let's take a look at the theta on this. -14 versus this negative. So option strat actually multiplies it already. So this is technically would be -0.14 right here. In comparison to this, do you see how that's significantly less theta, which means it's easier to swing because the risk of theta is essentially cut in half. And what's even more important is we're keeping the cost pretty much the same. It's costing us the same amount of money, but we're eliminating half of this risk, and we're essentially keeping a delta that's almost the same, but we're going closer to the money now by buying this 930 call. This actually has a chance for Tesla to hit because Tesla can move 100 points in 1 week, and it doesn't have to be an explosive week for it to do it, versus it going all the way this high. It would have to go 100 points higher. This is 930 right here. This is all we're saying we want Tesla to go to, but we don't even need it to go this far. It can actually just come a few points, up this way. It can be 50 points would have been a win for this trade. And I actually closed the trade out right here, I believe. So I swung it from here, and then I closed the trade here. And obviously I do wish I held because there was a lot more that came out of it. If I were to show you guys actually if I were to show you guys this right here, sorry if the dashboard is getting a little chaotic. I'm planning to do, I have so many YouTube videos to record, so they're going to be more in the style of how I do the webinars, so they're not entirely completely organized or as polished. I just want to try and get this content out to you guys as soon as possible. But what we're looking at is the spread. This screenshot was taken 10 minutes before the market closed today, so how it actually ended up playing out. So this is around the time in which we got filled. This was last week Friday, and that's what's it's saying right here. So 2:30. This was the Friday. On Monday, when I actually closed the spread, I believe it was right around this vicinity right here. So that is already a $200 win, and I took on maybe $60 was my risk. I was risking essentially half of what I had put in, and Tesla would have had to gap down or drop, I think, 50 points or so. It was a very wide stop loss, but because I'm taking advantage of how options work as well as how the option spread was structured, it meant my risk was very small, and I didn't have that, and I didn't have the massive theta risk, which made me comfortable to hold. And now we're talking about a profit target of here, but you guys can see this went all the way up to about almost $6. So from $1, I got filled at $1.15, but we'll just rounding it down, we'll say $1 to $6, and I didn't have the massive risk, and I can continue to hold something like this as the week transpired. This obviously Tesla ended up closing just below 930, but I was looking at 930 because it's where I was expecting it to actually be towards power hour today. So this is 930, and that just came from understanding the premiums and understanding the max pain and seeing where option sellers would have wanted Tesla to end up closing. As we opened the video at the beginning, I mentioned using this right here, the information on Quant Trading app. This is the upcoming expiration. We can see that its premiums are now significantly balanced relative to how Tesla has been in the past, and this was actually today's expiration. So the premiums actually ended up balancing themselves out perfectly, and it's just the way the market works, and it's beautiful to be able to see this week after week. And if it doesn't happen, because Tesla didn't rally all the way up to 900 last week, but then the following week it ended up doing it, a lot of the puts were sold. There was over, again, about $40 million in put premium between the two expirations, that more than half of that evaporated within that given day. And I was walking people through it on my Instagram live because it was just comical to see who's still buying puts down here. The people that with a lot of money are actually selling a ton of puts because they're expecting it to rally. And I want to take the trade on the side of the people that actually understand what's going on. And lastly, I want to point this out. This was a different spread. I didn't want to run this one, even though I was analyzing the two. In hindsight, I do wish I took this trade. I just didn't want to put more than $100, $150 or so in the time and risk over the weekend. And if we look at this right here, we'll see that this was even safer, because this is with the assumption that Tesla is just going to be above 880. And if there was anything I was definitely sure of, it was that. So I took this screenshot as I had opened it. Now this is the analyze same time, a minute before the market closed today, just to show how this one played out. This is saying all we need Tesla to do is be above 880 and this spread would have been profitable. There's no risk to the upside, so it didn't matter how high Tesla went, it would still profit. Again, just based on how the butterfly was structured. So in this case, we're selling 2 of the 900 call, we're buying 1 of the 880, and then we're also buying 1 of the 910 calls. And we can see for $2.35, this one just had a beautiful P&L, and it ended up closing today just before the market closed, or 10 minutes before the market closed. This one was going for $10. So we're talking about close to an $800 win on this swing. And on the other one, max profit was up about we'll say $500 or so. So between these two alone, obviously take the profit on this. This only took $100 essentially to open, and this only took, we'll just round this up and say $250. So with $350, your return on swinging Tesla with this opportunity would have been over 1.3k, and your risk would have been, we'll say, half of this, so $50 risk on that spread, and on this your risk being about, we'll say, $125. So between the two, you're talking about $175 in risk, and that's if you swung over the weekend and held for a few days. That's how much risk to get this type of return. So we're $175 to make 1.3k with a solid plan, understanding the opportunity in front of yourself. And this is the stuff that's important, guys. If you're trying to build an account, I'm talking about you have $2,000 in your account, these types of opportunities is how it's actually much easier to build up that account versus coming in and trying to scalp this, because I know there was a lot of scalpers that lost a ton of money because everyone expected Tesla to just skyrocket at the open. It pops up, it drops down, you lose money, then you come in here on a smaller time frame, you're scalping this, it's that VWAP, it comes back. This just drives you crazy when you're trying to day trade, even though you know it's very likely to go up. Why not just position yourself in a place that it's less stressful, less risky, and take time to actually plan out your trade? So guys, if you have any questions about Quant Trading app or anything, link is in the description to the Discord. This is a premium service. I am the lead developer on it, so full disclosure there, and there's a lot of information on Quant Trading app. The bi-weekly webinars, as well as a lot of information is included. And if we come here, this is what we have in Quant Trading app. We have these automatic levels from the algo that lets us know where a good places to buy and sell. And this is when I mentioned earlier in the video, Tesla was below the Quant Trading app 2 sigma level, which is saying it only closes below this level 1 in every 10 times. So us being below it on Friday was giving the extra confluence to be bullish. But more importantly, the way the market had been selling off, this provided enough context to know that it was very likely to be bullish going into the next week. So it's just a little bit of extra confluence. But as I said, I wanted to save some more of the Quant Trading app confluences towards the end, because even if you're not a Quant Trading app member, there's a lot of information here just in traditional technical analysis, as we pointed out, over 5 to 6 reasons, and then we had a little bit more of an edge with Quant Trading app. So guys, if you enjoyed this video, if you learned a little bit, if this was your introduction to spreads or butterfly spreads, I'm sorry if it was a little bit confusing. I do need to do a dedicated video. I highly recommend you guys do your own research. Take a look at what's out there. I recommend the Option Volatility and Pricing book by Sheldon. That's known as the Bible on options. He goes over butterfly spreads and different ways to capitalize on this type of opportunity. It's definitely the type of year in which you're going to want to take advantage of these spreads and let this be a great trading year for everyone. So I'll catch you guys in the next one. Thanks for watching.